Only 3 bullet points now. So the project is due a week from today, and then homework 13 is due the Wednesday after Thanksgiving, and then we've got our final exam in the last time slot on the last day of finals. So that's it. We'll talk more about the final exam as that gets closer. But my calendar's filling up when it comes to availability to help you with the project. I think the best way for me to do that is with an in-person meeting or maybe Microsoft Teams. It's a lot more challenging to just like send emails back and forth and make any meaningful progress. For example, if you want me to help you fix some problem on a spreadsheet, then come see me in my office, or we can talk about it on Teams, but that's the best way to do it. And I'm happy to help you, but I imagine that I'll get a lot of questions in the next week, so the sooner you do it, the better. Okay, we're going to be moving into chapter 16 today and talking about depreciation. And this is something that a lot of students are already familiar with, simply because they've seen the rapid loss of, usually they've seen it with cars, how vehicles lose value so quickly soon after they're purchased. And so just the concept is usually on people's radar, but oftentimes what they haven't talked about before is the different models that are used to actually keep track of depreciation and why businesses like depreciation. It's a little bit counterintuitive. Like we usually think of depreciation as being a bad thing, the fact that your equipment is losing value. But actually businesses like depreciation and they want to get as much as they can as quickly as they can. So we'll talk about why that's the case. Anybody have questions before we move on? Yeah.
Yeah, I didn't submit my homework. I'm not asking for an extension, but the whole thing about the lowest two being dropped, that's calculated after everything?
It's that drop is currently, like, that's applied right now.
No, thank
Yeah.
you. Okay. Not the answer I was hoping for. But
Yeah, I applied that just a couple of weeks into the semester.
All right, thank
So,
you.
yeah, your homework grade should already be deflecting that, or reflecting that. Okay, so depreciation. It's an accounting method to allocate the cost of an asset over its useful life. And so rather than accounting for the expense of some tangible asset all at once in the year that it's purchased, for accounting purposes, what depreciation does is says, let's figure out how to distribute that over its useful life. And so every year, you're taking a fraction of the cost of that equipment off the profits that you have to pay taxes on. So here's just a figure that I found online that is showing that within the first year, for example, the value of your vehicle may go from 100% of its purchase price down to 80%. And then the next year, maybe it goes down to 70% of the initial purchase price. But a pretty commonly accepted idea is that it's flattening out, that curve, the slope of the curve is getting less steep, simply because cars continue to hold a certain amount of value even when they're 20 years old. This is just a conceptual figure, by the way. There's plenty of cars that are worth more than 4% of their initial purchase price after 20 years. But the overall trend that this is illustrating is just that early it loses more of its value compared to later years. So depreciation just means the decrease in value of equipment over time, but it's the tax consequences that makes depreciation most interesting to us. And that's because it's a deduction against the income that firms make in a given year. So the loss of value of your equipment is something that you can write off as an expense, and it reduces the amount of tax that you have to pay. So that's why companies want to have a lot of depreciation. It's not because they want their equipment to break down quickly. They want the tax depreciation. They want to have as much of their income shielded from tax as possible. And if you're saying, oh, my equipment had a big loss in its value this year, then that's going to shield some of your revenue against being taxed. So it's tax depreciation rather than the physical effects of aging that companies are excited about. So to calculate depreciation, there's some terminology that we have to be acquainted with. And the cost basis, which in our in-class exercise today, I'll assign that the variable B. That's not only the initial purchase price, but also the sales tax and then any costs that are required to put an equipment item into service. And so that might be training expenses, shipping or transport costs, installation. So it's the all-in expense of getting some item operational. Now the book value in any given year K, so here K is just referring to a certain time period. So that's the asset according to accounting records at a given year. And that's not necessarily the same thing as its fair market value. There can be wide fluctuations between what an equipment item is actually worth and its book value. The book value is just how much of its initial cost basis hasn't yet been depreciated in a given year. And there's a formula and different approaches that tell companies how much depreciation they're allowed to take in a given year. It's just not up to them to decide how much of the initial purchase price they're going to deduct with each year. But in fact, the government has a system set up that most depreciation will follow that kind of formulated tables that I'll show you a little bit later. But not all things get to be depreciated. So for example, when a company is buying paper towels for the break room or toilet paper, that wouldn't be depreciable because it doesn't have a useful life of longer than a year. And in the same way, you can't depreciate things that do have a useful life of longer than 1 year if they're not purchased for business purposes or to produce income. So clothing that you'd buy, that's a personal thing. It's not necessarily a business expense. And so there are certain limitations on what can be depreciated. It has to be something that wears out. So you wouldn't be able to depreciate real estate, just like the land component of it, because land isn't worn out over time. It doesn't become obsolete or lose its value. You know, land is land, so it has perpetual value, so it's not depreciable in the same way that a tractor would be. You also aren't able to depreciate the inventory that you actually plan to sell. And so if you're in the business of selling farm equipment, then it may actually lose value as it's sitting on your lot. You know, a piece of farm equipment that's sitting out waiting to be sold for 18 months maybe isn't worth as much as it was when it first came onto the lot, just because it's gone through the weathering cycle and maybe it's becoming obsolete just because it's the off-model year. But it wouldn't be depreciable because that would be considered the stock in trade. So all of these things just are the criteria that have to be met. And remember, the reason why businesses want their property to depreciate, like to experience tax depreciation, is because then it reduces the tax they have to pay on profits. And so remember, profits are revenue minus expenses. And tax depreciation is an expense. And so it's a way of reducing on paper what your profits are. Otherwise, you'd have to pay extra tax to the government. So there's a couple of models for how to calculate depreciation. And for us to understand the way that it is actually done now today, we have to know how it used to be done, because the current system of how it actually is calculated is based on a blend of older methods. And so it's important to know these older methods to understand the current approach, and also the FE exam does ask questions about these older methods as well. So straight line depreciation is where you're assuming that every year there's an equal amount in terms of an equal number of dollars that are lost in tax value or in the book value each year. And at the end of the useful life, there could be a salvage value of the equipment, or it could be depreciated all the way to zero. But a salvage value is an option when it comes to straight line depreciation. And it's called straight line because it doesn't have that curve that was illustrated here. So this is like a non-linear depreciation where every year is a little bit different. Straight line just connects the dots from the beginning to the end, and there's a straight line between them, and that's why it's called straight line. So we'll look at the equations for that in a minute. But declining balance is what was illustrated on that previous slide, where the depreciation is a constant fraction each year, but the number of dollars that are depreciating is reduced with each passing year. Because let's say, for example, you'd say each year you're losing 20% of the book value compared to the previous year. Well, if the book value is going down every year, then 20% of that declining amount would mean that the depreciation number of dollars each year is perpetually getting smaller. So here salvage value can also be considered in declining balance depreciation. Now, MACRS is the Modified Accelerated Cost Recovery System. And that's the current approach that's used for depreciation. And it's just a table that you can look up in each year what fraction of the equipment's value should be depreciated. So it uses these service life classifications where, based on the category of equipment, you assume it's going to have a certain number of years of depreciation. So, for example, garbage trucks would have a certain number of years that they're assumed to depreciate over, and then this table would tell you what percentage of its initial purchase price is depreciated with each year. And it doesn't terminate in a positive salvage value. It terminates at zero, at no salvage value. And that's good. According to the companies, they like that, because that meant that they were able to depreciate the full cost of the equipment. Salvage value is a bad thing when it comes to the tax consequences of depreciation. It's a good thing if you're thinking that you're getting rid of equipment and you want to have some residual money that's coming back to you when you dispose of it. But remember, when we're thinking about the tax consequences of depreciation, salvage value is bad because that just reduces how much of the initial purchase price you're able to write off. You want to write off the whole purchase, and so you don't want salvage value. So companies like this Modified Accelerated Cost Recovery System, and the reason why they like it partly is that it depreciates all the way to zero, but then they also like it because it starts off fast. It starts off with a steep slope where they're able to depreciate a lot of the value early, and then it switches over to a linear model at the end. So here's the formula for straight line depreciation. The difference between the book value and the salvage value is the total number of dollars that are being depreciated over the useful life, and N, the recovery period, is generally either a category number of years, just based on what kind of equipment it is, or its actual useful life. So it's a certain amount of time. So the depreciation per year is going to be the same. So D sub T is the same for every year in straight line depreciation. And so once you know that amount of dollars that are depreciating each year, then you can find the book value in any given year, T, by starting with the book value, the cost basis, which is the book value in year zero, starting with the cost basis, and then subtract out the number of years multiplied by the depreciation per year. This is a very simple formula. And so the depreciation amount is constant with each year. So it's a linear curve, straight line depreciation. So just as an illustration of how this works, if you had some equipment, a gas argon processor, that has an initial cost of $20,000, that's B, our basis, $20,000. And S, the salvage value, is $5,000. So that means that we're depreciating $15,000 worth of value over 5 years. So obviously, if it's $15,000 is the incremental value that's depreciating, and it's happening over 5 years, then that means $3,000 per year of depreciation. So that's the depreciation in year 1, that's the depreciation amount in year 2, in year 3. That's the depreciation amount in each of the years through the end. So then the book value in year 3 would be the cost basis of $20,000 minus 3 years of $3,000 per year. So the book value, that's how much of the initial purchase price is still on the books from an accounting perspective. At the end of the 3rd year is $11,000. And then here's a figure that just shows the book value over time. So any questions about straight line depreciation? Okay. Let's do the in-class exercise for straight line depreciation. Let me give you the paper for that. Okay, so in this example, we've got 3 pieces of equipment. We've got a loader, a mixer, and a crusher. And we want to know, basically for each of them, how much depreciation happens each year. This is the straight line model. So basically, go through and find out what is the D, the depreciation amount, in each year for each of these equipment items. And so find D sub T for the loader, the crusher, and the mixer, and then find out what is the total amount of depreciation in year 1, what's the book value of all the equipment in year 3. We're kind of going through the process of applying these 2 formulas for those 3 equipment items. So for part A, the sum of the depreciation in year 1 is $21,773. Because we've got the loader, which is about $5,300, the mixer, which is about $6,500, and then the crusher is almost $10,000. So add it together, and we get $21,773 is the total depreciation of all 3 items in the first year. Even though those 3 items each have different recovery periods, we're doing this accounting exercise once per year. So the company can write off $21,000 worth of this depreciation. They're counting that as an expense, one of their expenses. Okay, now part B is asking what's the book value of all the equipment at the end of year 3. So to do that, we start with the beginning book value for each of the items, and then we subtract out 3 years of depreciation. So 3 years of depreciation of the loader, the mixer, the crusher. So then we find the book value of each of the individual equipment items and then add the 3 items together. So it should be $121,179 and 74 cents. Any questions so far on part A or part B? Okay, so then at the end of year 5, let's look. At the end of year 5, the mixer has already depreciated down to 0. So the mixer's out of the picture at the end of year 5. So the equipment is just the loader having experienced 5 years of its depreciation plus the crusher having experienced 5 years of depreciation. So the sum of the book value at the end of year 5, $84,107. And then in year 8, the loader is finished, the mixer is finished, it's just the crusher, and the crusher has its standard amount of depreciation in year 8. It's the same $9,955.56 for the crusher each year. So that's a taste of straight line depreciation. Does anybody have any questions about the concept there?
For D, would you not include the salvage value of the loader?
Well, this is just asking the depreciation. It didn't ask the book value.
Okay.
Yeah. So if it had asked for the book value, then what we would have done is we would start off with the cost basis minus 8 times this depreciation amount. But it just only asked the kind of the magnitude of depreciation that occurs for the company in year 8. Yeah. Good question. Are there any others? Now, declining balance depreciation starts off where you're going to, instead of having a constant amount of dollars each year, there's a fixed percentage of depreciation that occurs each year. And sometimes the way it will work is that the problem statement will tell you directly what that percentage is, and that's assigned the variable lowercase d. And so typically the max rate for D would be double the slope of the straight line depreciation amount. And in declining balance depreciation, obviously you can't depreciate below some salvage value. And it's not possible to depreciate to 0 with the declining balance model because there's always some residual amount if each year it's just a percentage of the previous year that the depreciation occurs. So the way that you calculate the depreciation amount for a given year would be you find this factor D, calculate it, or it's given directly, and then you multiply it by the previous year's book value. So if it's 20%, you're saying this year's depreciation is 20% of last year's book value. That's just an illustration of what you'd do if D was 0.2. Now, sometimes D is defined by a percentage. Sometimes you'd calculate D based on a known salvage value at the end of the useful life. And so if you knew after a certain number of years, N, what the salvage value would be, then you can calculate what D value, lowercase d, corresponds to that. So we're going to get a taste of both of those approaches on the back side of the paper for the in-class exercise. We're going to calculate D with a defined percentage. We're also going to calculate D if you had a known salvage value. And then you can find the book value in a given year either by just subtracting out the depreciation on a year-by-year basis, just do it like one row at a time, or you could calculate it directly for whatever year you're interested in, for year T, it's the initial cost basis multiplied by 1 minus D, where D is this factor, to the power of T. That gives you the same approach as if you had repeated row by row the depreciation amount on a sequential basis. Okay, so here's just an illustration before we start on the in-class exercise. Let's say that we had a truck that had a first cost of $80,000 and it lasts for 10 years. So if we were following 150% depreciation and we wanted to know the depreciation and book value over time, then let me see if I've got that illustration here. I wonder if I've got the numbers here. No, I don't. Let me make this larger. We'll look at it together. All right. Okay, so for 150% and 10 years, we're starting with some defined book value, but we won't know the salvage value to begin with. That's going to be kind of like at the end of our calculations, a consequence of the 150%. So if it's 150%, that means D is 0.15 because D is defined as the percentage divided by 100 times n. So we're doing 10 years here. And so what you'll notice is that for each year, the depreciation is 15% of the previous book value. So the book value being 80,000, that means that in year 1, the depreciation amount is 15% of that. So 12,000 is based on the 80. So then the book value at the end of the first year would be the previous year's book value minus how much depreciation happened that year. And so the fact that this is 10,200 arises from 15% of the previous year's book value, and then the book value of year 2 is the previous year's book value minus the depreciation amount for this year. So hopefully in the back of your mind, what you're thinking of is how you'd set this up in Excel. I mean, it's illustrated as Excel, but hopefully by now you kind of instinctively are thinking about, you know, cell references and dragging the formula down and so on. So at the end of our 10 years, we end up with a book value of $15,750. And that's just a consequence of 150% being the slope in the D value being kind of the driving force here. Now in part B, we know that the salvage value is given as 10,000. So we have to calculate what D value, what fraction is going to yield that in the end. So if you put in the known salvage value, the initial cost basis, to the power of 1 divided by 10, what we get is that the D value would be 0.1877, and then applying that for each year in the same way that we did here. The only difference now is just how did you get D, lowercase d. After that, the formula within the spreadsheet is the same. You have a book value, the depreciation amount is this lowercase d factor multiplied by the book value, and then the book value of any given year is the previous year minus the depreciation amount for that year. All right, so that's kind of the nuts and bolts of how it works. So let's look at that for this part 2. Hopefully you've got your laptop with you today. I think it's a lot quicker if you do it by Excel, but you can do this by hand. It's just maybe a little bit more tedious if you're doing it repetitively. We want to know the depreciation in the book value for the whole sequence of years, for all 8 years if you're doing it with Excel. But if you're just doing it by hand, maybe try and do years 1, 2, and 3. But we're going to do it according to the 150% declining balance approach, or if you've got the known salvage value. Okay, so for 150% and 8 years, a given book value of 486,000, D is calculated. So this is the formula we use for D. So let me show you, I'll set that up. It is the percentage divided by the 100 times 8. Okay, so that gives me the fraction. And now the book value at time 0 is just the basis. Now, the depreciation amount in year 1 is this fraction. I'm going to anchor the reference because I always wanted to refer to that, multiplied by the previous year's book value. So 91,125, because that is 18.75% of the previous year's book value. So at the end of the first year, it is the cost basis minus the depreciation amount for that year. And now that I've got those two formulas defined for the depreciation amount and the book value, I can just drag it down through the remainder of the sequence. And then it terminates with 92,305. Like, that's just kind of the output of it being 150% depreciation. Now for part B, we have a defined salvage value. So D is calculated in a different way. It's calculated using this formula. So let me type that in. It is 1 minus the salvage divided by the cost basis to the power of 1 divided by 8. Okay, so that helps me to calculate lowercase d. Oh, I think I've got an error here somewhere. Maybe I need to put a parentheses around it.
I think it's just...
That's more like it. All right. So then the table part's the same. Once you've got the depreciation factor, then the depreciation amount is the factor multiplied by the cost basis, the previous year, which for year 1 is the initial basis. Okay, the book value is the previous book value minus the depreciation amount for this year, and then I can just drag it down through the entire sequence. And it terminates, the way we can double check to see if it's right, is it should end at 87,000, which was the given salvage value that we knew we were aiming for. So that's declining balance depreciation. So when we get together on Friday, we're going to talk about the modified accelerated cost recovery system. One more thing. Raise your hand if you'd be interested in me posting an extra credit assignment. Okay, keep your eyes peeled on Blackboard for that. It's optional. It can only help you. Can't hurt you. But I'll put it on Blackboard this afternoon, like later today. Did you have a question?